In today's video, we will explore the relationship between the rising 10-year yield, corporate debt, TLT, and the stock market. Why is the Fed walking a tightrope that leads to the next financial crisis? We'll also take an updated look at the TLT technical analysis. Alright, let's jump right in. Let's start with corporate debt levels in the United States. We can see a clear long-term trend of increasing debt levels for corporations, and on top of that, the trend is accelerating. Corporations are currently over $11 trillion in debt. These debt levels wouldn't be as much of an issue as they are right now if these companies' profits were rising in proportion to the debt payments, and if the interest rates on taking on new debt was not going up. What does the corporate bond yield have to do with the 10-year Treasury yield anyways? Corporate bonds, and therefore the cost of borrowing for companies, is tied to the 10-year Treasury yield because corporate bonds are more risky than government bonds and have to entice investors by offering an additional interest rate premium above the rate on the 10-year Treasuries. The spread between the two rates is called the yield advantage for corporate bonds. As 10-year yields go up, the cost of corporate borrowing goes up with it, and will start to squeeze indebted companies in their ability to borrow to stay afloat. This also affects stock buybacks, which is the questionable practice of companies borrowing money to buy back their shares. Next, let's take a look at the quality of companies that are taking on some of this debt. If you haven't heard of the term zombie companies before, these are indebted publicly traded companies whose debt payments are actually higher than their earnings. Many of these companies are insolvent companies. According to this MarketWatch article, about 30% of the Russell 3000 index companies are zombie companies. This is 10 percentage points higher than the average and is at a level where previous bubbles have burst, both the dot-com bubble and the Great Financial Crisis in 2008. Some of these companies are not just some small companies either. Household names like Tesla, Uber, Roku, and Wayfair are on this list too. Let's take a look at this chart of Tesla and the 10-year yield to illustrate how investors are repricing the risk of investing in some of these growth stocks as yields rise. We can see that Tesla was in a trading range between January and February, but when the 10-year yield broke out to the upside, the Tesla price clearly broke down. What's worrisome for stocks is that the yields have been rising at an accelerated pace. Next, let's look at the 10-year yield to see if we're close to a consolidation point where rates might take a pause. Looking at the weekly chart, we are currently at 1.73% and heading into a consolidation zone between 1.8 and 2%. The relative strength index is telling us that the quick move up in repricing of rates is overextended in at least the short term. My current view is that rates will not successfully breach 2% in the short term, and if they do, it will be a quick spike during which I may consider buying the TLT ETF for a short-term trade as yields correct lower. Now let's look at TLT technicals. Looking at the weekly view, TLT is now the most oversold since the ETF was created in 2009. If you watched my previous video, I suggested a price range of 130 to 135 as a good risk to reward ratio short-term trade. I still believe this to be true, although a spike low below 130 is certainly possible as the 10-year yield approaches 2%. How much lower can TLT go in the short term? Based on this TLT chart with GAN fans added, it looks like there should be some solid support in the mid-120s if 130 fails. How am I planning to protect my downside in this trade? I'm about 50% in cash because if TLT plows through 120s and continues to go down, it means that the 10-year yield continued going up and will eventually cause stocks to crash. I would then plan to use the cash to buy discounted stocks while the Fed finally steps in with yield curve control to prevent rates from going higher. The Fed has made their actions clear at the press conference this week. They see the market raising all sorts of alarms for inflation through the rapidly rising bond yields, but the Fed is choosing to ignore them because they know that if they even as much as show an openness for future rate hikes in the Fed funds rate, it will cause the financial asset bubbles to start deflating. This is because the market is forward-looking and would start to price in a Fed tightening cycle. Powell instead chose to reaffirm that they will not raise interest rates until 2024 and try to convince the market that the inflation will only be transitory. It won't work. What happens next? In my opinion, the market will continue to reprice longer dated bond yields higher over the medium term and until something in the market breaks. Whether this is a larger correction in the stock market, say 15 to 20%, or something in a market plumbing system that cuts the funding ability of financial institutions. The last thing to keep a close eye on is the dollar, as it could light the tightrope that the Fed is currently trying to balance on. The dollar has been in a clear downtrend since the unprecedented fiscal and monetary response to the pandemic in March of 2020. But as we can see in this chart, it appears to have made a potential bottom. It's currently above the 50-day moving average and testing previous support, which is now resistance. A breakout above the 200-day could create issues for emerging market economies since a lot of their debt is denominated in dollars and will become more expensive to service this debt. A higher dollar would also act as an anchor to stock prices. In my opinion, the easy gains in the stocks are over outside of some sort of yield curve control or yield stabilizing on their own. What are some of your top stocks and ETF holdings? Comment below and let me know. See you all in the next video.